Your two core strengths were always understanding liquidity, right? Really understanding it, and dealing desk strategies. And that's something that I wanted to pick your brain on today.
The last 10 years, you have a lot more risk-taking entities who are probably getting better at taking risk.
So what's the difference then between those tier one, tier two, tier three, and you know, the different types of liquidity, ECN versus banking liquidity versus a recycler? Is there any difference in what you're receiving as a broker?
Yeah, I mean, if we talk about a tier one bank, and I think there's even less today that are actually truly making a market. I would say that the real difference is where price originates versus where it doesn't. And where it originates, you can generally find somebody that can probably solve some problems that you might have or give you some solutions that others might not be able to.
So ultimately, you're more likely to get filled at the places where the price originates, or is that a wrong assumption?
It's a good question. Whoever is originating or making a market should give you better execution than somebody that's not.
When we look at our statistics, and very often tier two-ish, one-ish, it's all, unicorns and rainbows until you hit it. And then,
Yep.
and then there is no love anymore. What would you say is the ideal risk book for a mid-sized broker or
One you
smaller
can
broker,
afford.
larger broker? What would you say could be classified as healthy retail flow versus something that is sharper that you potentially want to straight away take to the street or not touch at all?
Yeah, I mean, generally, it's quite easy to tell when the market runs away from you very quickly that this is not something you want to be touching.
Welcome to Your Bourse podcast. I'm your host, Elina Pedersen, the co-founder of Your Bourse, the fastest matching and trading technology in the retail FX and CFD market. Today, I'm joined by Jacob Plattner, a seasoned FX and CFDs executive with decades of industry experience, from COO at Alpari UK to co-founder of Scope Markets and now the CEO of Azul Markets. Jacob has built and led brokerages at every stage of growth. Welcome, Jacob, and let's dive in.
Thank you, Alina. Happy to be, your guest. I think that's a great honor for me.
I've been trying to get you to join one of our podcasts for a few years now, so I'm truly honored.
Thank you very much for having me.
Thank you for joining. Let's dive into your career path and how you entered into the FX and CFDs environment. So where did your career begin?
Boy, that was a long time ago. My career began in Boston in the United States, and I had studied finance and accounting in school. One of the first jobs I was lucky enough to find was a sales role in a company called IFX, which was a reasonably sized broker out of London, and they had a regulated office and branch in the United States. So I started in cold calling and retail sales right out of
Real
school.
cold calling.
Yeah, I mean, it was before the days of people working on Salesforce and a number of different CRMs. We got a Excel sheet every day or every week, and we were trying to get people who are interested in some sort of different markets besides equities at the time. Futures were becoming more and more popular, and FX and there were no such thing as CFDs in the United States. There still aren't. So it was all just FX and metals that we were selling. I did that for, let's see, it was a little over, I think, 2 years at IFX. I think the last probably 6 months at IFX, I started to learn a system called Currenex and was getting more involved in the institutional side. My brain at that moment was sort of like, if I could not have to contact 150 people a day and I could contact, let's say, five or six that could introduce me to thousands of clients, then maybe that would be a better way to earn commissions. So I was introduced to Currenex, and I started learning that system as well as I could. And IFX at the time I was leaving had been bought out, and I moved to a company called CMS after that. doing exactly the same thing, but started with Currenex. We built an institutional desk for them, which was, I think, pretty successful. We're the first ones to use Currenex at the company. We were one of the first companies to start using Currenex's retail product, and we built a reasonable book of business. When we had done that, CMS had also gotten bought out by Gain Capital. We had then, decided, okay, like, it was quite clear that it wasn't going to be a long-term solution for us. And this is when I moved to Alpari. Alpari offered me, they had already been a client of Currenex. We're using it, I think, a little bit, but not heavily. And I was able to start a institutional desk for them in Boston. And it was after a few months of trials and tribulations, it turned out to be a really good spot, I think, for both Alpari and for myself. I would say that was kind of the moment where my career really took off. We were able to start using Currenex in a different way. Instead of just having everything passed to the streets, we were booking a lot on Currenex, using a lot of their tools to help kind of make markets to different clients. And the institutional division at Alpari really grew. We became, I think, a good percentage of their business. And after doing that for, I think, about 3.5, 4 years, there was a relatively big management change at Alpari. When that happened, the current board and owners asked me to step onto the board. It was a great opportunity for me. As from a sales perspective, I looked at it as, I could probably do sales for a long time, but they offered me to move to the UK and US. The industry was, I don't want to say dying, but it really was kind of changing and evolving into being something that wasn't so much retail orientated and more geared towards the, let's call it, institutional hedge fund family office space. So it was a great opportunity for me, and I got to basically get thrown into the management side of the business, which kind of turned out to be where I am today. As everybody, I think, in the industry knows, Alpari unfortunately went under during the Swiss franc repeg in January of 2015. And after that, I worked for a brief stint with GKFX, managing their I would say their global business with the CEO at the time. And again, it was a nice place because they had just started to kind of see all of the work that they had done go into, like, they could actually see it coming to fruition. So I stepped in at a nice time, was able to help with some experience that I had to help bring everything together. And we also started an institutional desk, which again took off quite well. And then, I was there for about a year and a half, and I had kind of, at that point in time, really understood that I didn't want to work for another owner. I wanted to be an owner. And one of my clients at the time I'd been speaking with a while, which was Scope Markets, again, I had an opportunity where I could come in and join not only as the CEO, but also at an ownership level. And that was the sort of last place I was before, co-founding Azul with a couple of other guys. And Scope was just a phenomenal experience for me. I mean, in like both blood, sweat, and tears, it was just really fun. We were about 10, 12 people when I joined. The company was in Dubai at the time. We moved everybody to Cyprus. A large part of the firm was Turkish, so it was really cool just from a geopolitical standpoint to see
Daring, very daring.
yeah, Turkish. We had the first visas that we applied for were 5 Turkish nationals in Cyprus, but we had no problem. We got everybody there. We started again. The market was a good place in 2018. We started to take off, and let's call it 5.5 years later, we got an opportunity to sell the business, and we did. And then 2 years, I took a little time off, and now I'm being dragged back into an industry which I think everybody knows it's hard to not be dragged back into. Yeah,
I
that's
think
me in
we've
a
all
nutshell.
been through it. We've all been through it.
Yes, I
Right.
know you have.
Yeah. So I've met you about probably 13 years ago when you were at Alpari already. And I've always known you as a very risk focused, like in the best possible way, right? You would always be a numbers guy. You'd always be like, oh, exposures are this. This is what we're doing. This is our risk. It's interesting, actually, for me to learn that, even for me to learn that you came from a sales background. So how did you transition from a sales role into the operations, very risk focused role?
Yeah, I mean, I think it was really natural. One, I mean, I had some level of understanding, let's say, very basic from an educational standpoint, having a finance background in school. But I would say the real, understanding and trying to do this was more from the sales side, because when you're speaking with brokerages, it was not easy, especially at that time, to get in the door. I mean, it's still not easy, but to get in the door and talk to somebody, because it was still cold calling. Like, I was in Boston. Most of the business was either being done from, let's call it Israel or Europe, and so speaking to somebody over the phone, trying to get in touch with, somebody that had basically manages somebody's risk or liquidity, it wasn't easy to speak with them unless you could kind of speak their language and understand the things that they were going through. So I put a lot of time and effort into understanding, what needed to be done from, let's call it a dealing desk standpoint, or the monetization standpoint, and all of that comes with some level of understanding risk, right? That was really how I got into it, and I wouldn't say I'm the most I'm great at risk, but I think from an understanding of what needs to be done, what needs to be looked at, what needs to be sort of put in place, I think I understand pretty well. And it's come from that, like the basics of getting in the door and making sure that the person I was talking to understood that I knew what they were going through and could be there when they needed something, was the real reason I think I have the understanding and the experience I do with the risk side of the business.
So you've exited Scope 3 years ago. Was that your first exit? And what led to the sale of the
Yeah.
baby that you worked on so hard?
Okay, yeah. So, yeah, I mean, I would say it's a first exit. I mean, if we talk about, there were some things that we looked at when I was at Alpari, which gave me some level of understanding. And I would say my real level of understanding came when it went into administration. As for about, 3 to 4 days, we were constantly looking at either selling the whole business and then afterwards selling parts of the business. So I got to really understand, a lot of the, let's call it data that companies would be looking at. And from my side, from scope, I think from, I guess, my side and the shareholding side, the reason we decided to sell it is, one, we got a good offer. We were originally looking at sort of bringing another investor or investment into the entity for growth. At the same point in time, in this period, we had gone through COVID, things were obviously very rosy, and then things became more difficult. So, and we had grown a lot, and as companies do when they grow a lot, usually they have more costs than they need. We were no different. So we started looking at the parts of the business where we thought we were really strong, which was institutional. We had tried to grow retail. I think we were successful in some ways and unsuccessful in many others. One of the things that COVID did was it pretty much killed all of the grassroots campaigns that we had. We can no longer be on the ground in a number of different places.
Mhm.
We were never trying to compete in an online marketing space. It just wasn't who we were. It wasn't what we thought we were going to be able to achieve. So COVID really killed a lot of our retail initiatives. And at the time of looking for investment, Rush, was one of the ones we were speaking with, and they made an offer to buy the entire entity. I was, I think, the only owner at the time that they made the offer working in the business day to day. And to be perfectly honest, was quite tired.
I remember.
The offer was good, and all four shareholders kind of agreed that this was a good price. It wasn't, it was never the design, it was never the thought process we had when building and setting up the business was to sell it. We always, I think, wanted the business to be either in our family or run by other people that had been in the business with
Mhm.
us. But yeah, this was the way it went, and I think at the end of the day, it's been a good thing. Like, I think from what I can tell, Rostro's done a good job growing out the institutional side of that business. A lot of the employees and, let's call it, management that we had at the time when we left are still there, doing really well. And yeah, so I think it's been a good thing for everybody. But yeah, that's the basic reason for
Just
selling.
very quickly, you've mentioned it briefly, and it kind of I've raised my attention. So, what are the key metrics that investors are looking at when you're going through M&A? Because you said, "Oh, I kind of knew what they were," but then it crystallized when we were selling.
Yeah, so I think it's going to depend, right? It depends on what the company that's where they are in their phase. So Rostro was new in the fact that their owner had a business which was doing mostly equity CFDs, but wanted to grow and knew that if they were going to grow, they needed a bunch of different things, not only including like meta licenses and other regulatory licenses, but people, infrastructure. So I think one of the things that they looked at with us is that this would probably, save them maybe 2 to 3 years in terms of where they could get to, which is anybody that's sort of built a business, especially in this industry, realizes, that's might feel like a short time, but it is a long time to be sort of building. So from that standpoint, I think they looked at it like this. We had a lot of good people. We had a strong institutional base, but we were able to give them a platform in terms of all of our global licenses, all of the people that we had, and all the infrastructure that we had built, including risk management tools, a number of different tools operationally that would have just taken them a long time. That's one. And in terms of others, I think, like if you're going to look at like some of the other acquisitions that are going on, they're looking at client base, and I think first and foremost, is that client base, is it introduced or is it direct? What technologies are they using? And then sort of what that looks like in terms of overall revenue and how that might fit into their book, and then where they can immediately cut costs. I mean, rolling up brokerages and cutting costs is the primary reason I think for acquisition in this space, because as I think everybody knows, there isn't a whole lot of differentiating brokers out there in terms of the overall market. You just have a lot of different brokers that are selling to, let's call it maybe the same geos, but through different intermediaries or through different marketing channels. And for the most part, that's what they're good at. And so the differentiating factor is generally, let's call it small, but where you can really make an impact is having a number of different buying a number of different brokers at a relatively good price and cutting costs and rolling them up into one brokerage, which we've seen throughout a number of different instances in this industry.
So tell us about Azul.
Azul was set up with the idea of, again, something similar to what we were looking at Scope, but I hope will be a bit more well-rounded. So our first step is getting into the institutional space, which is what I understand and know well, where I think, there's some low-hanging fruit for us in order to be able to cater to different institutions in terms of providing just a niche price feed or liquidity feed or a number of different instruments where we can provide more support, more help, to these companies. But the overall long-term picture outside of that will be to grow the investment side. So we'll look at more physical products. CFDs and FX will always be something that we do, but I think the long term, we look at it as, and I don't think it's just us, I think it's a pretty well picked up on trend in the industry. The investment products are probably going to be the place where most companies need to focus, especially if they're going to look at acquisition and providing real value to clients over a period of time. So we will start working on that, I think, next year in 2026, and also trying to offer, come up with a better geared retail product. Our focus is going to be much more geared on sort of how we onboard clients. We're going to try and gamify a little bit the onboarding experience to help clients understand what the product actually is before getting involved, especially for those that are beginners. And at the same point in time, doing our best to simplify all of the products that we can. I mean, nobody really understands margin, leverage, tips. All of it is foreign to pretty much anybody that hasn't traded for a while, and you can still talk to a lot of, I think traders that do trade by a mobile phone, and they still don't know what half of this stuff is. So we'll do our best to simplify that. And I think as we look up the sort of the chain, we are looking at how we can possibly get into the payment space as well in the next couple of years. So well, I don't think we're sort of looking at it from a very different level across maybe a number of different brokers in the industry. I think we will try and differentiate ourselves into how we look across the industry and what value we can add to retail clients. And from the institutional space, we'll continue to try and grow the products that we have, and slowly start to build out the risk side as well, so that we can offer even some more value, I hope, across these different places.
So the risk side, that's what we're here for. In my eyes, your two core strengths were always understanding liquidity, right? Really understanding it, and dealing desk strategies. And that's something that I wanted to pick your brain on today. And I think we can start with liquidity, if you don't mind.
Yep.
And in your opinion, if you look at today's landscape, how could you categorize the liquidity providers or the liquidity that is being offered to the brokers?
Ooh, that's a good question. I mean, so I would say everything for the most part is regurgitated still. You don't have too much unique liquidity, at least that I can see. I think one of the things that's, in the last 10 years is you have a lot more risk-taking entities who are probably getting better at taking risk, growing up a lot in terms of how they monetize, what they look at. But yeah, I mean, I would say for the most part, there isn't a whole lot of differentiation across the liquidity streams. And if we go back to kind of 2010 through 2015, before the Swiss franc, it was quite easy to access bank liquidity and PBs. You didn't need too much money in order to do that. Now it's relatively impossible. You're going to get up with a tier two PB at best, and the access for credit lines are going to be small. So it's almost, I mean, I keep looking at it, and I don't see much point in having a PB or going this route. So, but yeah, I mean, there are still a number of different providers that I think differentiate themselves. But if you're looking for something that's not regurgitated, you need somebody that's going to take risk at the end of the day.
Why is PB not relevant anymore? Having a PB is
I
not
just don't think
relevant
you get much
anymore.
value from it at the end of the day. Like, it used to be that, like, for, let's call it $5 to $10 million, you could access almost all of the major liquidity providers, whether they were non-bank or bank. And now, you need a significant amount more. You're not getting much in terms of credit. So you're not getting anything that you can't get, I think, from, that's not fair. You're not getting what would be of any real value that you could probably get from, let's call it, other LPs, or in a lot of cases, maybe some binary relationships. So, facing let's call it a non-bank LP one-to-one versus sort of with credit elsewhere. So you can have a credit relationship, with an LP directly as opposed to using a PB. And I think you get much more value in that than you do with, let's call it, through a PB. So unless you have a massive balance sheet, I just don't see where you get any value in having a PB these days.
So back in the day, let's not specify which broker that was, but back in the day, I remember that in your book, you had a very similar dollar per million on both your A book and B book. It was quite similar. So at the point, like it didn't really make sense for you to take as much risk on your B book. Is that because of the prices you were getting from your PBs, or is that more of the time that we were in? Or what was the reason if now it's not relevant anymore?
So, I mean, listen, for us, it was twofold. Like, as you know, some business LPs will fight heavily for. So when we looked at I think we were quite different at this time. Like, we were basically sending a lot of our retail business out to LPs because they were almost paying for it at the time. So we would have an incredibly good risk-free dollar per million, and we had very good credit relationships in line. So it was a good model. At the same point in time, as we started to get into, I wouldn't call it toxic, but as we got into, let's call it, some of the institutional flow, or some of, like, even at this time, bigger the Asian business or Middle East business, which were very, very, let's call it, volume driven. Like, you would get huge volumes in very short periods of times, either through EAs or money managers or just very high net worth individuals. That wasn't easy to send to the street. Like, they didn't, like, the top of book and was very small. As you worked your way down that book, it became quite evident that, the price was not very good, and they would complain. So for that, you had to run risk. You had to consume that and then decide how you were going to manage it in order to keep clients happy and to take the flow. And it was not bad flow. It was just something that had to be managed as opposed to passing off. But this was a time when the race to zero was really starting. Everybody was fighting over a lot of the same brokerage flow, same retail flow, and you had new entrants coming and taking on the banks like XTX, and Citadel is now done across a number of others. So yeah, it was a different time, and now those players are still here, and they're being faced just, I think, in a different way besides using a PB.
So what's the difference then between those tier one, tier two, tier three, and you know, the different types of liquidity, ECN versus banking liquidity versus a recycler? Is there any difference in what you're receiving as a broker?
Yeah, I mean, so if we talk about a tier one bank, and I think there's even less today that are actually truly making a market. Probably, from my understanding, maybe 3 to 5, and maybe that's fair, maybe that's not fair. But there used to be, I think, more. I think it's harder to make a market, especially at that level where they're seeing so much of the volumes coming through and having to deal with a number of different fragments of the industry, as it is a very fragmented industry. So if you look at a tier one level, the one thing you can understand is, you are getting somebody that's truly making a market and can probably cater to a lot of different needs, and they're generally where price starts. As you start working your way down, and you have different, I guess you could call it tier one price providers that are still pricing off of other tier one price providers.
Okay.
But as you start to work your way down, you start to realize even that, tier two banking level, almost all of it's recycled or getting from somebody else. The ECN level is, it depends which ECN you're obviously looking at, because again, you can have a lot of recycled liquidity inside of the ECN. But at the end of the day, that's a place where you can hopefully find pools that are designed for needs that you might have.
Okay.
So yeah, I mean, I would say that the real difference is where price originates versus where it doesn't. And where it originates, you can generally find somebody that can probably solve some problems that you might have or give you some solutions that others might not be able to.
So where are you? So ultimately, you're more likely to get filled at the places where the price originates, or is that a wrong assumption?
It's a good question. Being filled is going to be dependent on, a number of different factors. In terms of where you get filled, it might not be dependent of tier one, tier two, tier three, as opposed to do they really understand your business and what you're being, what you're looking for. At the end of the day, everybody's looking at, fill rates and sort of market impact, but or they should be. But I think, listen, I mean, we've worked with tier one, providers where fill rates are worse than, let's call it, tier two. It's not, I wouldn't say, this necessarily has to do with, one's going to be better at execution. They should be, as long as, like whoever is originating or making a market should give you better execution than somebody that's not, if they understand your business and are providing you a solution that is relevant to what your needs are, and if they understand the risk that they're taking when doing it.
Yeah. To be honest, I must agree with that because, when we look at our statistics, and very often tier two-ish, one-ish, it's all, unicorns and rainbows until you hit it. Once you hit it, then you hit it.
Yep.
And then,
Yep.
and then there is no love anymore.
Yeah, I mean, well, at the banking level, like desks also move around, right? I can remember times with, working with JP Morgan and Goldman and UBS. UBS was more of generally a mainstay. Like they were always pretty strong, especially in gold. We can remember like Bank of America, JP Morgan, Goldman's, like the desks would move around, and you'd be like, well, why did pricing change and execution change? Or, we're having some operational changes, and then you realize, okay, this person's popped up at a different bank, and the team has gone with them. Yeah, I mean, things change. Things change, but it really depends on if you can understand, the execution statistics and work with the provider at the end of the day. Like if they're working with you and you're working with them, then execution should be what everybody needs at the end of the day. And enough for the LP in order not to be, let's call it, in order to make markets in a risk framework what they're comfortable with, and for the brokerage side or taker side to be able to get the execution that they need in order to fulfill and provide to their client base or to their own trading that they're doing.
Okay, so how can a broker tell a good LP from a bad LP, and what are the red flags you would look at as, let's say, a startup broker or, less experienced broker?
That's another good question. So from hard to say about red flags, but if I look at like the things like what should be, how can you kind of tell whether somebody's there to offer you something or just to sell you something, is what if they can listen to you and you can explain what you need, and they come back with something that sounds like that, as opposed to just giving you what they have. If you're going and asking, just for what somebody has, you'll get what they have, and it might not be geared towards what you need. So I think the big things that startup brokers should be asking for is, one, I wouldn't be reliant on, like, let's call it 10 LPs. I would say somewhere between 2 and 3. I can tell you the way we look at it is we're trying to match LP to client as much as we can in terms of what the LP's strengths are and what the client is looking for. And at the same point in time, if you're new, it's hard to have relationships, but the more you can understand who you're dealing with in terms of balance sheet, whether they're running risk, whether they're not running risk, what they're offering you. So whether that be margin requirements, spreads, overnight credit, funding facilities. I mean, these are the most general important things I think from the start. And then what type of service they offer. I mean, I think one of the things that I was successful at, and the others that we have dealt with are also successful at, are generally servicing clients even when they're small. So helping them get off the ground as quickly as possible, making sure that even if the question seems silly or out of left field, maybe that they're still answered and you hold their hand through it. If you can find brokers that can help you from that standpoint, then I think you're in a really good spot. If you're just, I think the red flags are sort of looking at the companies that have no real understanding of your business, don't really care to understand your business, and are just offering something sort of off the shelf or offering somebody else's product as if it's their own. These would be the kind of things that I would stay away from. And to be honest, the bigger the broker at this moment, in some cases might be better and in some cases might be worse. So it's really trying to figure out what you need and what your requirements are, and trying to match that as much as you can with, I think, one to five at most LPs.
Is there a benchmark that you would look at in terms of, standard offering, which is not too good to be true? Because obviously if there is an LP saying, well, I'll offer you swap free the way it was a few years ago, it's just too good to be true, right? It's just not possible. So maybe there is
Yeah.
like an NLP limit that they need to look at, or like margin requirements, something like that.
I mean, so yeah, I mean, margin requirements are going to be like anything funding related, where, if you're a startup, obviously you need as much capital sitting in your accounts as possible as opposed to your LPs in order to keep your business funded to start growing it properly. So yeah, I mean, the better requirements you can get in terms of margins are great. Same with NOPs. But I think these like, if you're a startup, generally your volumes are going to be relatively low to begin with. And if you're, let's call it a startup who maybe has, I don't know, a bunch of different clients that are willing to move over, then I think you generally know what those clients are looking for. So it's better to match those. Like swap free is possible. It's very hard when you look at it from, let's call it, past the 3 to 5 days, because then you leave yourself open to a significant amount of abuse. And especially as interest rates have continued to, let's call it, increase, or they're no longer non-existent like they were, it's not really conducive to swap free trading. But I would say the biggest things to look at is who you're facing every day and whether that, let's call it, person brokerage is available in order to make sure that you have what you need. I don't think there's like, I wouldn't say like, oh, so somebody's giving me 0.2 on euro and somebody's giving me 0.1 on euro, I'm going to go with 0.1. That doesn't really make sense to me, because clients are not as price sensitive as everybody says they are. Clients are much more sensitive towards, of course, they're price sensitive, but somebody losing, let's call it, $5 to $10 per million on a trade, unless they're trading significant volumes every day consistently, should not be so worried about that. They should be more worried about, am I getting executed where I said I'm going to be executed? Are the services that are being provided actually there? So, I mean, I think these are the things that are important at the end of the day. I don't think, let's call it, one thing is important. There's just, are my needs being filled? And are they being looked after when I have a problem? And can somebody help me solve a problem when I actually have one?
Okay. Okay.
Yeah.
So let's move more into like a dealing desk specific questions now. So when you look at a brokerage, and because you ran brokerages and you ran risk books, what would you say is the ideal risk book for a mid-sized broker, or
One you
smaller
can
broker, or
afford.
larger broker? Fair enough.
I would say listen, I mean, it's what your competencies are at the end of the day. Like if, for example, at the scope, we didn't have a retail book really. Like, but our competencies were really strong in terms of managing, let's call it, gold flow, trading, let's say not the markets, but clients. So client behaviors were really important to us. It wasn't a matter whether they were going to, let's say, win or lose. It was a matter of what they were going to do with the trade. So we were constantly looking at patterns, constantly looking at different scenarios as to what would happen if market moves for or against. So our competencies were much more geared towards this. If you have a retail book, maybe you don't need to be as sort of geared towards these types of understandings. You need to be understanding more, okay.
Just just sitting on exposure.
Well, I mean, obviously, you need to have limits in place to a certain degree, unless you have an unlimited balance sheet. But no, I mean, you need to understand sort of who's going to hurt you, who's not going to hurt you, and then filtering as much as you can, deciding which products you just don't want to touch because they don't really fit into your risk book, I think is important. I think like concentration is a huge thing in terms of concentration per product, concentration per client. These are really important things to understand.
Sorry, I'm just going to ask a question here. Would you look at them individually or would you look at them as a basket of setting?
We would try and group them as a basket as
Okay,
much as possible. I
okay,
mean, there
okay.
are some clients that you might want to look at on an individual basis, but I think they're few. So mostly, trying to understand, let's call it some that are maybe like fully leveraged and always geared versus ones that are sort of not so aggressive, and then those that are sort of following extremely well detailed risk parameters themselves. Clients that are understand sort of where they're going to be hurt and where they're going to make money is another important thing to understand. And again, there aren't maybe so many of them, but I think that's starting to change. I mean, I think that's evolving a bit. Clients seem to be a bit more educated, a bit stronger, especially as you get into the markets that are have been around for a while. I mean, European clients don't seem to not understand the idea of leverage anymore and not understand where the risks are. But yeah, so I think
So is that where the market impact comes in, or market impact is more about sharper flow?
I mean, it's always good to understand market impact, especially, I mean, listen, if you're, let's call it running risk at scope, generally we were never sending anything directly to the street. Like, usually we understood if something it needed to go directly to the street, there were probably better places for these clients to trade than there were for us. It was just not where we focused. Whether that was right or wrong, we wanted to anything that kind of came in through us, we wanted to touch our risk book first and then decide what to do with that. So I think, yeah, it's tough
Can you tell me
to.
what would you say is market impact if you need to give a definition of a market impact?
I mean, it's what's the market doing before the trade, and then what does it do once, like after the trade?
So spread decay, ultimately
Yeah,
markouts,
yeah. I
right?
mean,
Okay.
correct. So and these are what we would generally look at. I mean, especially when you have some abusers. But going back to kind of what I was saying, like scope, we wanted to understand, like if we were pushing our trade into the market, was it having a great market impact? Because in general it wasn't, but this was something. If it was, then maybe it was also an understanding that would help us about how smart the client was or not. So looking at market impact was always something that we would be looking at. What happens pre-market, pre-trade, and what happens after the trade were always important things for us to look at. And if the market's jumping around, I mean, it can be very different, right? Obviously, if it's a very volatile time, it's hard to really understand. At least for me, it was
Mhm.
hard to understand market impact. If it's not volatile and it's normal, then it's easier to understand market impact.
So based on market impact and in general your knowledge of risk, what would you say could be classified as healthy retail flow versus something that is sharper that you potentially want to straight away take to the street or not touch at all?
Yeah, I mean, generally, it's quite easy to tell when the market runs away from you very quickly that this is not something you want to be touching. It, unless you also have something there to earn from it, like meaning you need to get out of a trade, so it's not a really big problem for you. But generally, when immediately afterwards, somebody's placing a trade, the market starts to move away from you and in their direction, that this is generally sharp flow. I don't think there's too much science elsewhere that would say that. I mean, clients have gotten better in terms of hiding it in some cases, but yeah, I mean, when the market starts to move away from you pretty quickly, you start to understand that you're mostly on the wrong side of that trade.
Is there anything you can do about it?
Yeah, I mean, so one, if in terms of a risk book, you can, if you have the ability to also affect the market, great. I never did.
Go for it.
Yeah, but I think other than that, like there are pools of liquidity that are designed, where people can play in them regardless of what they're doing. So I think finding those kind of, whether you want to call them dark pools or pools that are set up specifically so that they are matching as much flow with people that are constantly trying to get in and out of a trade, regardless of anything, regardless of market impact. So, I have I don't know, a certain amount of, gold that I need to get out of at this price. I don't care what happens to the market afterwards, just get executed. That's great for somebody that is going to move the market afterwards, and then nobody cares. So I think finding these are the only way to really deal with them from a brokerage level. I mean, maybe from let's call it a high frequency shop or somebody that has a lot more infrastructure and knowledge as to how to deal with that flow. Maybe there's something that can be done, but I haven't found too many other places other than pools where you're putting a bunch of anonymous users together that are there for the same reason, which is to get in and out of trades at prices that are, where they don't care about market impact. So this is the only thing that I have found that kind of works for that type of business on a long term. And knowing that the pricing is significantly worse than
Okay.
you would expect to be streamed for, call it, let's say, this normal business.
Okay. So I'm just thinking that obviously market making as such and skewing could potentially be, as I see, something that brokers are trying to implement, and it's becoming more and more popular. So brokers are getting smarter with the traders. Is that one of the ways to be able to digest through that sharper flow, or potentially the client won't be happy if you're trying to skew the price too much?
I don't know. It's hard for me to say because I haven't done it. Like
Okay.
I just haven't with that type of business. Like I said, most of the time, like with Azul, like we are working with a couple of these pools to start dealing with some of the more difficult gold flow that's out there. But in terms of trying to, let's say, use market making techniques to deal with it yourself, it's not something I've done. It's not something that's been of interest. I think there's enough for me. There's always been enough good business to go after that's more important to fight for than this type of flow. So I think as you get bigger, it's important to probably figure out how to manage it better, but it's not been
Okay.
something that I've had to deal with.
Okay. So, in terms of the indicators or key metrics, what would you be looking at on the daily basis at your dealing desk, or would encourage dealers to look at?
I mean, obviously profitability is number one, but let's say in terms of how we get there, I think your overall risks, whether that's, looking at kind of bar to give you some ideas to how much you should have at risk overall. As I said earlier, like concentration per product was always a big one. If you have a huge concentration in one product, you need to focus a lot more on what's causing that concentration and how to manage it. Concentration per client for sure. Dollar per million per product would be one that we would look at, and certainly we would try and understand dollar per million per product versus dollar per million, and sorry, dollar per million per product on a B book level versus dollar per million per product on an A book level, and how that looks. So trying to understand, okay, if we're making, let's call it $50 per million on the B book, and we could be making $40 per million on the A book, does it really make sense, or do we need to be doing something different in terms of either widening, charging more, or looking at different liquidity venues in order to price off of? So these would be some of the ones that we would generally look at, and then as we discussed, obviously market impact after trade, and then really trying to understand how well the clients are classified and whether they're doing what you expect. So, if again, if we kind of had those baskets, okay, these ones are highly leveraged, these ones are not so leveraged, or these ones, we know that they have solid risk techniques in place, and but are they all fitting the way that they should? So constantly trying to classify clients correctly and understanding if they sort of break those molds or if they continue to work correctly are the general things that we would look at. And then, yeah, I mean, trying to understand what limits you should have in place constantly in order to protect yourself as much as possible. And in a lot of cases, also when should we open these limits? And that for me was more geared towards client behavior than it was towards what the market was doing. Obviously, if the market's moving in a specific direction and it looks like it's strong, you can open up a little, but as clients are trying to trade the market. So if you try and also trade the market, at some point, sometimes you become just another client. It's difficult to do it that way. But yeah, if behavior, like for example, if we saw a lot more behavior going in a direction that made sense to us, then we might want to open the book up a little bit more.
So how do you benchmark? Like, how do you know what's your expected dollar per million per product should be?
So we look at it generally from an A-book perspective first. So if we were to pass it to the street and then we take maybe a certain percentage off for, let's say, execution, all the costs around that, what do we make dollar per million? And then what would we expect if we were to book it? What would our dollar per million be? And, is there a good risk reward relationship there? So it's pretty easy from this perspective to kind of benchmark like what we would expect, and then what we would try and, when we would try and take risk would again be more around the competencies that we could actually, handle. Like if we had a strong risk team, great. If we have institutional clients, you need a very strong risk team that understands this type of business. There's also lots of good retail risk, dealers out there who wouldn't necessarily be, ones that I would want to stick behind an institutional book, and vice versa. So I think the main thing that we would look at is just that kind of dollar per million versus what we would get a risk B.
So what would the formula for BBOT be? Would it be just like a standard spread function, swaps and so on? And then if there is a deviation from it, that would be out of the scope? Or is there
Yeah,
anything else that you look to benchmark?
I don't I don't think so. I mean, it's hard to like, I wish I could say there's something, more clever about this, but
Spread
no,
and swap?
yeah, I don't think so. I mean, at the end of the day, this is where you have the potential to earn. This is what the client is charged. It's also what you're charged from an LP perspective when you are trading with your counterparty. So no, I mean, I don't see much more. I mean, I think lots of people can come up with more to it, but I don't think there's so much more to it. There are a lot smarter people in this industry than me, but no, I can't think of a sort of something else that I should be looking at in order to get going and really understand anything more.
So in your opinion, in terms of a dealing desk perspective, what do you think brokers should manage in-house and what should they outsource, if anything?
I think this really depends on what they're trying to achieve. I mean, if you're, let's call it a retail brokerage and you're a marketing machine, I would assume that's where you want to put most of your resource on in order of, doing really well in terms of acquisition cost and then retaining clients as much as you can. I mean, every broker obviously wants to do this, but if you're, let's call it heavily reliant on IBs or maybe affiliates to bring you traffic and clients, then you might be more geared towards running risk as opposed to somebody that's just literally a marketing machine. I don't know, like having not been maybe a part of a marketing machine myself, maybe I'm wrong, but then I would say like I would be focusing more on that, and then trying to again segment my clients as well as I could, but not focusing as much on, let's call it, risk strategies as opposed to like making sure that the clientele is segmented correctly, and either you match them off against an LP that's going to give you phenomenal pricing and deal terms, or you're taking, let's call it risk in a very simple fashion. And then after that, you pass off to the street again, as opposed to, like I said, those that are kind of working with IBs and affiliates where they have relatively high costs for acquisition and continual costs for acquisition. They're probably going to need to focus a lot more on how they can take risk on those clients. And obviously same for those that are trying to cater more towards the institutional space. They have to be well qualified to run a very strong risk book.
Yeah, so it all comes down to know your client. Doesn't
At the end of
matter
the
if
day,
it's
yes. Like, I
B2C
mean,
or B2B.
nobody likes to, say kind of this, but you're at the end of the day, an FX and CFD broker is a financial casino, and if you look at casinos, it's the same thing. They want to, but I mean, it's true. I don't think it's unfair to say, and but you have to be able to understand your client. It's the same with the casino. They want to understand the clients that are coming in through the door and making sure that the games that they have are geared towards those clients. I don't think it's any different in the FX and CFD space, other than the products are different and so forth. So if you don't know your client, I think you're in trouble.
So let's close this section with just one last question. I think if we've covered a lot. So what do you think are the biggest operational pitfalls that brokers face when they set up their dealing or when they run their risk book and decide on their liquidity providers, really?
Well, I'm going through this now, so I guess I think some of the biggest thing is not understanding the tools and technology that you're using as well as you should, especially a management level, because then even if you have other people working for you, you can't really understand what it is that they're trying to do or what they're actually working with. So understanding, let's call it your tech stack as much as you possibly can and how it works and how it's supposed to integrate with all of the other parts of your business and then how it faces your client at the end of the day is probably one of, I think, the biggest pitfalls we see. And I can say I can hold my hand up as guilty of having been there as well, but like you really need to understand all of the tools that you have at your disposal or that you're using inside and out in order to operate your business as effectively as possible. I think this is number one. And then number two is just trying to understand the cost of your business as much as you possibly can and fighting for literally every cent you possibly can without affecting sort of the service and solution that you provide. Running also like a strong team from an operational level is also one of the things that I think you really have to focus on. And it's not easy in our industry as it's a small industry and it's heavily incestuous.
Yeah, I mean, I think it's amazing you say that because, as you know, we literally just launched Dealers Academy and we had 0 members in the Telegram group. We didn't do much, we just sent a mail out to our clients and the response had been phenomenal. We literally have more than 70 people applying for the first course and we have a waiting list of people wanting to join it. And it's not just dealers, it's the company owners. And they ring us and they say, actually, before I send my dealers, I want to go through the course because for me, I want to understand what I need to be looking at because I don't understand dealing as good as I should be understanding it. And I think it's great. It's a great advice for the company owners to actually understand the metrics that they should be looking at so that they can be on the same level with their dealing desk.
Yeah, and I think it's a great initiative. I mean, I think one of the things, and it comes in a number of different industries, but I think our industry is unique in some ways. The level of education, both from client and all the way up to brokerage, is very, very small. You don't have so much resource out there that is quality resource. Again, a lot of it, if you look at it, is just heavily regurgitated. So I think it's a great initiative, and I can understand why you would have so many people interested in it, because where else are they going to find any relevant information and that they can get that isn't kind of, let's call it, coming from people that are doing it every day versus somebody that's maybe teaching it as, and
Yeah.
so, yeah. I can see this as a good initiative and one that you would have a lot of people looking for.
Thank you. Actually thought I'll end this section, but I saw one more question that I really wanted to ask you. And well, most predominantly because of your scope experience, how do you monetize sharp gold flow? Tell us, is there a secret sauce?
I think, listen, at my level, I don't know if I know how. The only thing I can say is just trying to find, like I said, pools that will accept it. I mean, other than that, like, the only other way is, I think, at some point in time playing games. And I think this is what happens even at a higher level. It's like they try and understand when somebody's going to try and, let's call it, do some level of arbitrage, moving markets, and they understand. So then they will move it in advance or they will move it shortly afterwards. They will hold on to the trade. I mean, this is a zero-sum game at the end of the day. And, the only way the only way I've seen a way of doing it, if it is sharp, it needs to be in a place where, there is no interest in market impact after the trade is done from those that are basically being hit versus those that are taking a price or being
I
matched
think that
off against.
I think that's a very good advice because that's ultimately what I'm seeing. I mean, yes, there are some liquidity providers that would take it, and sometimes it's questionable what they would do with it. But yeah, that been my experience as well. It's only someone that is not interested in the market impact that could really potentially take the flow.
Yeah, yeah, and pricing is going to be considerably different. Like in some
Exactly.
cases, nobody cares. Like so, when you can find that, there's a way of doing it. But usually, the sharp flow is there to basically, I mean, not all of it, but a good percentage of it is there just to hurt somebody. at the end of the day. So whether you're going to pass that off to somebody else, you're just hurting somebody down the line. So as long as like the only way I know how to monetize that is you make sure that you understand that that's sharp and you understand where you can put that flow so that the other counterparty knows that it is also sharp and they have something that they can provide that says, okay, this is for that business. There'll be no complaints once that trade comes in because the other people on the other side are not worried about that. So yeah,
Just for you, just today, I just opened up our statistics and I can see that 85% of all flow, and that's random, right? Because we have, what, 130 something brokers working with us. It's 85 gold, precious metals, I don't see particularly, but I'm sure it's gold. Precious metals is 85% of all flow in May. Absolutely incredible. And that wasn't the case a few years ago. So my question is, where do you see the market going and how do you think it's going to change the flow in general in the coming years? I know years is a bit of a long-term perspective, maybe months or a year or
yeah. I mean, so gold. I mean, it was born as a gold house at the end of the day, but it was a large part of our flow as well. I think if you look across retail, still it would be a very strong percentage. Anywhere from let's call it 65 to 70% of overall flow. But you look at it, I mean, it's gone from 1,500 to now 3,300 in a couple of years, and you have 2,700. 2,500 all the way up to 3,300 in the last 6 months. So 6 to 8 months. So why would you expect not to see a large amount of flow coming in something that is moving and giving lots of trading opportunities? Where there is movement and volatility, there will always be a significant amount of, let's call it, I think, trading flow. Going forward, I would expect to see more in crypto. Like, I think
Mhm.
clients should be trading a lot more in crypto as that becomes more volatile and more mainstream. I think indices, you have Donald Trump in office, you have a lot of geopolitical things coming. I mean, nobody knows what's going to happen with Ukraine, Russia, Israel, Middle East. You can throw Asia into the loop now as well, so
it really is quite sad, you know?
it is. I mean, but like, as that, like, I don't see any of that gearing down. I see it gearing up. So as that continues to, I think, mushroom, you will see a lot of trading opportunities in indices, a lot of trading opportunities in equities. And I definitely would expect the currencies to start moving again more and more. And time will tell. But gold, I don't think will. I think you'll always see a large percentage of flow in gold. Let's call it the people that trade and the geos that brokers are in. Gold is an easy thing, for clients to understand, to trade, and it moves.
So we're in for a few years of good market. Last question, promise.
Mhm.
So what trends are you looking at right now or watching closely in the retail trading space? Could be trading platform, could be anything else. I don't know.
I've tried really hard not to look at the trends in the retail trading space, to be perfectly honest, is we've tried really hard, or I've tried really hard not to follow them. The things that I think are important, where I think brokers are starting to do more and more simplification, like I said. So simplifying what they offer and how they can offer it to clientele. I think education, as we've discussed a little bit, is still extremely important. I think if you want to grow this market at any level, we're going to have to focus a lot more on educating clients, making it easier for them to understand what sort of potential the product has for them, and what risks the product has for them. In terms of platforms, yeah, I mean, I haven't seen anything new or groundbreaking, that's of interest, but it would be interesting again to see how, you know, I think if we start looking at what can, the old days of looking at a chart, or maybe not the old days, but like, I don't like the idea of a chart. Like, I think it's just looking at the history. It can give you some levels and understanding. So it's not to be used, but, I think content and giving content to clients, so news, things that can help be more predictive about something that can move a market or give you trading opportunities are far more important and not very well like done at this moment. So, building more news and more content that can easily be understood. So it doesn't have to be long articles, but snippets of what's going to happen. I mean, even just, Trump's going to speak now. He's going to be talking about these three things. You don't really see this in real time. You see it afterwards. And I think those things would be of interest. There's certainly some things that I think we'll be focusing on with Azul, when we look at building out our retail. So I think those are the most important patterns or most important trends that I would want to look at. Of course, I think the regulatory landscape's important, but seems to be in a relatively, let's call it, unstable balance at the moment, which doesn't seem to be changing.
Okay. Thank you very much. It's been a great pleasure to have you here. Thank you for joining us. What should I say? I should say, otherwise, my marketing will kill me. I must say, like, share, and subscribe. And if anybody would like to reach out to Jacob, please do let us know and we will put you in touch with Jacob. But Jacob, thank you so much. And I wish you all the best with Azul and good luck.
Thank you very much for having me. I really appreciate it. It was a lot of fun. Hopefully we can do it again.